get right to our talk of the tape today. It is, of course, the Fed decision and what it means to your money in the weeks and months ahead. Well, let's ask our headline guest today, Jeffrey Gundlach. He is the CEO and CIO of DoubleLine Capital, joins us once again in an overtime exclusive interview on a pivotal Fed day. Jeffrey, welcome back. It's good to see you as always.
Good to see you, Scott. It's hard to believe that 2 months passed so quickly since we were on last Fed meeting.
And so many things happen. Your reaction to today's decision, one in which our own Steve Leisman said the Fed out-hawked the hawks. Is that how you see it?
It's pretty hawkish. I mean, he started out just saying we're strongly committed to getting inflation to 2%. That's pretty clear. Sounded a lot like Jackson Hole. And then 6 minutes later, he said the exact same words again. And so they're very aggressive. The problem that they're going to have is that the inflation rate has gone up so much more than they expected, and they're trying to get it to drop just as fast as it went up. And the market pricing and the consensus of macroeconomists say that they're going to succeed at getting the inflation rate down to 2% fairly quickly. In fact, the trajectory that's priced into the market for the decline in inflation is actually slightly faster than the increase was from below 2% to 9.1 on the CPI. What's weird about the way the market and economists are thinking is they think that the inflation rate is going to go quickly down to 2% and then somehow magically just stop there and go dead sideways. In fact, the prediction of economists is going to go stay at 2% for a couple of years after that. But the bond market is not really reacting to these inflation numbers anymore at the long end. In fact, today's post-Powell bond market action is very recessionary looking. We have that moment that I talked about in past appearances. It's here now, that moment where we have the Fed raising rates and the short end reacts to it. Rates on the 2-year Treasury are up about 5 basis points today, but the long end actually rallies. The long Treasury rates are down 8 basis points today. And so now we've arrived at that moment of the yield curve that is truly flashing red for economic problems, and of course Jay Powell acknowledged that that's the base case. Those data points are a 50 basis point inversion from the 2-year to the 5-year, from the 2-year to the 10-year, and a 25 basis point inversion from the 5-year to the 30-year. These are really flashing recessionary signals. Jay Powell said that the unemployment rate was probably going to go, per the committee's expectations, would end the year at 4.4%. Well, a very strong indicator of recession is when the unemployment rate crosses its 12-month moving average. And the unemployment rate is at 3.7, and its 12-month moving average is at 4.07 right now. So if the Fed is right and the unemployment rate rises to 4.4 by year end, that will be a corroborative indicator of recession. Consumer sentiment is very weak as well. That looks recessionary. And so there's a lot of things out there that, and I'll just finish on one more data point, and that's the leading economic indicators, which are at 0.0 for 12 months and strongly negative if you analyze the 3- and 6-month numbers. So I read this as being recessionary. I was surprised when the stock market actually rallied during the press conference. I thought it was completely inappropriate. I think risk assets broadly are sort of going to be on the back feet for a while.
So there's a lot to unpack in what you just said, in a number of areas I'd like to go. You told me last week out in California that you worried the Fed was, in your words, oversteering, that they should just do 25. Well, I mean, obviously it appears that they're doing just the opposite of going 25, right? That they're in your territory of oversteering. I'd like you to react to a tweet by Senator Elizabeth Warren, who called what Chair Powell did another extreme interest rate hike. I've been warning that Chair Powell's Fed would throw millions of Americans out of work. I fear he's already on the path to doing so. Are you guys on the same page, you and the senator? He's doing too much in your mind?
I'm of the camp that the Fed should have done more earlier. I think it was in April or May, whenever it was, that I actually sort of facetiously advocated, because I knew it would never happen, for a 200 basis point increase at that time. And of course, the Fed has raised interest rates now, fully now by 300 basis points. And I think they should slow down. because everyone knows, the chairman said it so himself a couple of times in the presser, the monetary policy has lags that are long and variable. But we've been tightening now for a while, and the impact of these tightenings is going to accumulate into a recession. So I'm not sure I share the same rhetoric as Senator Warren, but I do think the Fed should be slowing down on these rate hikes. I think what they've got on their predictions for the rest of the year, going another, 125 basis points, up to about 4.25%. I think that is, I don't think they're going to be able to pull that off. I think the economy is going to be showing signs of weakening. So I do think the unemployment rate is going to go up, and I do think we're headed to a recession. And I think the Fed should have paced this differently, but now they're so committed to this 2% that I think the odds of a recession in 2023 are very high. I mean, I would put them at 75%.